that. 860-413-3938. Again, 860-413-3938. Now, and I'm Gary Byron, of course. So what if someone had a low credit before and now, they've got better credit? Is there a benefit to refinancing yet again?
This is one of my favorite strategies that a lot of people leave untapped, because I really refer to it as the two-step or the progressive refinance, where you do one loan initially. Maybe it was the first mortgage when they bought the house. Like the example I gave before with the gentleman with low credit, he got a high interest rate. He put a low amount down, so he had to do an FHA loan, which has a high amount of mortgage insurance on that loan. So the second step in that progressive strategy is, once your credit is where it should be, and what are we talking about credit score-wise? I would say high 600s, low 700s would kind of be that barrier to entry to get you out of that first-time buyer or that initial mortgage and into something more favorable. So there's one client in particular that I helped buy a home 4 years ago in Simsbury, and they bought this property on an FHA loan. They have 26 years left, had paid in 4 years on a 30-year mortgage, and their mortgage had over $100 a month in the mortgage insurance. That PMI we're talking about, it was at 4.25% interest. Again, back then, that was a great rate. The reason, not only their credit, but they had one particular issue. They had a bankruptcy only a couple years before buying the home, so they weren't eligible to get that conventional mortgage. But we had said initially, this is your starter mortgage. This is your initial. We're going to have an opportunity to get you a better mortgage in the future. We stayed in touch. We did annual reviews with them every year to make sure that they were in the best loan. And then here, just in the last several months, they were able to now refinance into a conventional mortgage. We got rid of their PMI completely, because now they had over 20% equity in the home due to the housing values going up and their mortgage going down. Right. Those two things combined, they actually had a lot more than 20% equity in the home. Their mortgage before was $1,614. What happened was we ended up dropping their mortgage. Actually, I'm sorry, their payment did go up $130, but here's what they accomplished. We took them from 24 years down to 15 years on their mortgage.
9 years.
And it only cost them $130 a month. It saved $115,000 between the PMI we got rid of and the interest charges, because we took them down to a 2.25% 15-year mortgage rate, which is probably the lowest or close to the lowest you've ever heard.
Do you get more people who contact you as first-time buyers or people looking to refinance?
I get a lot of both. People find me online now as a top lender in the Connecticut, just throughout, with all my reviews and the reputation I have online. So I can't say it's 50-50, but every client that comes to me to buy a home, I set the stage with them that you are buying the home. This is the mortgage you're getting to buy that home. Don't think for a second that you're going to keep this mortgage for 30 years. The amount of people that actually do that is pretty much nobody. I can't tell you somebody
why
I know
would you?
that's taken a 30-year mortgage and kept it for 30 years. At some point, the rates are going to change. At some point, you're going to have the equity buildup. At some point, you're going to have a change in your life that's going to require you to make that change. When people finally realize they can make these huge financial moves with really small cash flow changes, it becomes a no-brainer. It's just a matter of, are you going to take the strategy? Are you going to listen to the advice? Are you going to take advantage?
What about debt consolidation refinancing? Can you, really quickly give us some examples of that?
I'll give you a great example of that. I had a client also in Danbury down Western Connecticut. They had owned their home around 5 years when they came to me. They bought it with a normal mortgage. They actually put down a nice down payment on it. They got money from their family, who was very wealthy, and they had some equity built up in their home, but they had accumulated about $35,000 in credit card debt just from various things, not necessarily improving the home, but just living life, right? Kids, dogs, the whole nine. Right. So their credit card debt and their mortgage was $3,113 a month. That was the total of their debt. We refinanced them to a new 30-year mortgage. Their credit wasn't that great because they had a lot of high debt ratio, high debt utilization. So we had to put them in a loan with PMI. We had to put them in an FHA loan. And people might be thinking, wow, why would you go to a loan like that that's less favorable than the one that you bought the house with? Well, here's the reason why. Their mortgage and credit card debt was $3,113. by refinancing into this new loan, their new payment was $2,218. Do the math on that, $895 a month savings. Okay, that is game-changing for any family, especially those who are maybe on a fixed income or self-employed with irregular cash flow. $900 a month is life-changing, but here's where it got really, really cool. And this is where the big mistake we've talked about people make when they do these loans is they just pay that minimum and they pocket the $895 a month. This lady said to me up front, Rob, I do want to pay my house off. I see getting rid of the debt as the lifeline that I need to pay the house off. So what she decided to do was take the almost $11,000 a year that they were saving and apply that to the mortgage principal. So they took a 30-year mortgage and they're on track to have it paid off in 13 and a half years. It's 162 payments. It's less than half the time. Without changing their budget, they just took the money that was going to the credit card debt. We reapplied it to the mortgage principal. Now they're going to have the home paid off in less than 15 years, saves them almost $150,000 just in interest by paying that house off early. That, Gary, is what is available to people when they get out of the box and start looking at the opportunities that are available.
And yet, sadly, Rob, not many people are even aware of all of this, nor take advantage of these opportunities.
They don't. It's usually because they're afraid with credit card debt. Maybe they're a little embarrassed about the situation they've gotten into, especially if they've seen their credit score drop maybe from what it was before. But really, they just don't have an advisor. Even a great financial advisor doesn't understand most of the time these innovative, modern refinancing strategies that are available. 3-4 decades ago, no one was talking about debt consolidation refinancing. No one was talking about taking money that was going towards high rate debt and putting it onto the mortgage. Like, this is all things that have really come about due to modern finance here in America.
The only word of warning is you don't want to increase those credit card charges again.
Absolutely not. That's how you screw it up. And I tell my clients, now you've got a clean slate. We have completely changed your financial picture. Your credit cards are down to zero. Your credit score is going through the roof. You're saving all this money. There's only one way you screw this up. That one way is you get further into debt. And I will tell you, because I keep my clients accountable with these annual reviews, with this constant communication, most of the time, they don't get back into debt. But sometimes things happen. No one expected the pandemic, and those things happen, and you have to be able to pivot. You have to be able to be nimble and change your financial perspective, change your financial strategy. That's what this refinancing, this protocol we're going through, all these different ideas, that's what it's all about, is putting something new, putting something that's outside the box, putting something that's maybe even a little bit scary. Give it to an advisor, have a professional show you the way. You can make the decision, but if you can qualify for any type of loan like we're talking about, any of these strategies, it will change your life.
Folks, you are listening to Mortgage Matters radio show with Rob Weinberg. Rob, I always learn something new every time that we get together. I mean this. This debt consolidation, cash out refinancing, it is so significant. And the amount of money that people will save, it's not just going and talking to a mortgage broker or somebody, a mortgage advisor. I mean, you really show how it's much more than that. And all the more reason why you need to contact Rob himself. It's very easy to do that. 860-413-3938. Again, 860-413-3938. It's life-changing. I mean, it really changes everything for you. And of course, you can always email this show. Very easy to do that. Mortgage Matters Radio Show at gmail.com. Once again, Mortgage Matters Radio Show at gmail.com. For Rob Weinberg, I'm Gary Byron. Thank you so much to listening to Mortgage Matters Radio Show. Until next Saturday, have a good one, everybody. So long.